Good afternoon, everyone. I would like to welcome you all to our quarterly catch-up call. As another quarter went by, we witnessed new market highs and corrections. However, the question on everyone's mind is, how does the future shape from here on out? On this call, our founder, Vikas Khemani, will share his thoughts on the same. Without further ado, let me hand it over to Vikas.
Hi, thank you, Shloka. Good afternoon to all of you. Uh, uh, Welcome to again, our quarterly call, and I always look forward to chatting with you on a regular basis through this call. So, like always, I do encourage all of you to, make it interactive, post our initial comments, and through this 20 odd minutes of conversation, I would like to sort of take you through how the quarter was for us, how did we sort of fare, what are the few changes we made, what is our view on markets from here, so all those things I will try to cover. So let me just quickly get into first, our just 1 second. Yeah. So how did we do last, when markets were kind of a bit tough? How did we do perform? So I'm very glad to, and some of you might be aware because I'm sure you are investors with us and you are tracking our performance. But in case you're not, we have this is a summary of our performance across time periods of all our products at one go. And as you would know, our compounder fund, which is a multi-cap fund in existence for 2015, has done well. In last 1 month, when markets were down close to 5.5%, we ended up, 5.8% versus we ended up with only 1.7%. Last 3 months, 6 months, 12 months, everywhere, I think we have generated significant alpha. Last 12 months, we were up 55%. Average return, if you see, of our products is between 55 to 70% from a 12 months perspective. Uh, what gives me a lot of sort of happiness is if you look at the rightmost column, the alpha generated across all funds on a CAGR basis of all our fund is superior. It ranges between 6, 7, 8% to 20, 21%. Of course, shift strategy, which has been one of our breakthrough products since last 4 years, has done exceptionally well and continues to perform even if you see in last 1 month, 3 month, 12-month period. A bespoke portfolio has done very well. Bharat Amritkal Fund, which we launched, in May and started investing from 1st June, has again in this bad market, difficult market, has delivered very good return and alpha both on an absolute basis. It is up almost close to 13%. Which I think is pretty decent in this kind of market. So I think generally speaking, performance of our products across the board has been very decent. And but other interesting part, which we always try to tell you guys, that our product, we measure internally the qualitative part of our product faster, stronger, and cheaper. That the qualitative part of our entire actual portfolio, how does it stack on the earnings growth? How does it stack on the strength? And we measure strength by two factors, ROE and debt to equity ratio. And valuation is the cheaper part, right? So if you see earning growth of our portfolio is in and around 20 to 24%, which again is very, very good. ROE profile is 18 to 20% across all our products. And if you see, debt to equity ratio is pretty minimal versus benchmark. And valuation part is again, 1.1 to 1.3 peg. And lastly, but beta, our portfolio has beta has ranged between zero point 0.8 to zero point 0.9, which we think is very, very essential. Job of a portfolio manager is either to increase return or reduce risk or a combination of both. I am so glad that we have been able to not only deliver good returns, but also good alpha. But at the same time, we have also reduced the risk from a beta perspective. Also, I wanted to show you that how did we do in the turbulent time from that, see, market peaked in 26th September, and from there we saw 2 months of drawdown period where lots of participants were very nervous. And one of the thing I've always seen, that one of the quality of a portfolio manager or a investment house is also how does the portfolio fare in turbulent times and bad times. And if you see here, I think what gives me, great pleasure is that our, uh, uh, just one second, just one second. I think there's some, uh, I'm so sorry for just give me one second. I think there is one team told me that I was just referring to some unupdated PPT, so my apologies for that. But I'm just going to use the updated. There was some, I think, data error in one place, which is what. Yeah, correct. So how does the portfolio perform in the difficult times? And as we saw from the peak about 10 to 11% correction in this period of approximately 2 months. And if you look at our performance in this period of 2 months across all our products, we had a significant alpha, right? Except YNG, which is a small strategy, and also this strategy has a 47% CAGR. So I think, and this is also very bad underperformance in that sense in difficult time. But generally speaking, all our products had significant alpha and bad times. And this is what, again, I was trying to sort of highlight the fact that the resilience of the product or investment process is determined by the outcomes in difficult times. Of course, we will also have bad periods. I'm not saying that we are the smartest guys and we will not have bad periods, but at least it is just one more sort of testament to what investment process we've been highlighting and we've been following in building our portfolios over the last 5 years plus period. Now, coming to what basically we did in our what contributed to our performance, our portfolio is something uh, here in the slide that in way, and I'm not going to through all portfolio, but generally speaking, give you some sense in the major portfolios. Our compounder fund, we were significantly overweight, in pharma. IT, pharma API, IT, and select capital goods stock, which gave significant contribution to our product. And we've been quite bullish on pharma and API space for quite some time. IT, as you know, most of the people have been bearish, but we've been kind of we continue to remain positive on the segment, and we still remain. And we think that from a even medium term to long term perspective, IT as a sector will do pretty well. Um, and same thing, I think, has stood well in shift strategy in Amritkal. Across all, if you see, they have contributed. And this portfolio construct is both combination of top down and bottom up. Of course, we make our hypothesis around what's happening broadly in the sector, but eventually you have to go back and pick up the bottom up stories. What are the stories which will sort of benefit from this broader trend you are thinking about, and validate them and invest into them. So in that sense, our approach has been more combination of top down and bottom up, and some of these overweight positions have contributed to our performance in last quarter as well as more than that. Some of the stocks which has done very well for us as Newland Laboratory, which is I think almost I think we bought at 1,500 rupees a couple of years ago, and I think it's become 10x for us in some sense. Of course, last quarter also did very well, but I remember most people were kind of negative on the stock. We had got some of our about in one of the calls. I remember there were kind of a lot of flag for us also that why did we buy Newland and all. And today it has kind of again showed that what sometimes in 1 or 2 quarter can go wrong, but if your hypothesis is true, can eventually contribute to significant wealth creation and alpha. Today it is almost 10x or 10 more than almost 10x for us, what otherwise gave us a pain for, I think, 2 quarter period. Yatharth, again, we took quite contrary to the market perception, a bet on the healthcare segment in this. When IPO was kind of had received a muted response, and stock has kind of doubled for us, in last 1 year. Ola Electric, we bought an IPO, and what we thought probably will give us a return in 3 years' time ended up coming in a week's time. So we partly we booked our profits as well, but we took some bet on that, and that contributed to our performance. And some of these names we have recently bought, Paytm, where we feel that there's an interesting, turnaround happening. And while we never bought any of the new tech, so-called new tech over last 5 years, but in last one quarter when we found risk reward, we ended up buying some of them, and we did which in turn contributed or contributing to our performance. Shift strategy PCBL, many of you know that is a 5x for us and continues to remain well in this quarter as well. Uh, uh, Anup Engineering has done very well in this quarter. So, and many of these stocks have seen, by the way, 30% drawdowns in last, and which sometimes contribute on a quarterly basis to your performance. But as long as we believe that fundamentals of business are intact, I remember PCBL correcting almost 30% about a quarter ago. And in this quarter it has come back. So as long as you understand the business nuances of the business, you believe the management, we don't mind, staying through those intermittent periods of correction. So all of them have, I think, some of the stocks which you've seen have had, Kirloskar Pneumatics, I remember going through a consolidation phase and has done again very well in this quarter. Newgen Software, again, has been about 4x, 5x for us from the time we bought, has done well. So each of these stocks have been contributing in our performance. But honestly speaking, we have no way to know which stock will contribute to in our next quarterly performance, because our approach is to evaluate business fundamentally. From a directional perspective, some will perform in A quarter, some will perform in B quarter or C quarter, and we are indifferent to that particular outcome. What we are really worried and focused on is from a 3 to 5 year perspective: are we buying right businesses, or are we buying the betting on the right management? And that, I think, will always remain for us. Like LT Food, when we bought in Amritkal, stock was around 200 rupees in June. Today, I think it's almost close to 2x in 3, 4 months' time. And this was part of our magic stock, that this stock will get re-rated in times to come. And we still remain very bullish on that. But when we bought, many people thought, why are you buying a rice company, which is a commoditized business? But we did a lot of work, and we still believe that's going to be future multi-bagger for us. But we put our faith in it, and we continue to. So we don't mind taking non-consensus call. We don't mind taking, where we understand the business and we understand the management. Many of the stocks which you see, probably you will not find in common portfolio, but we have ended up taking bets on them because we like them and we understand them. And some of the things I have touched upon, that what worked for us in last 12 months in each of these spaces. And as you know, most of them, like banking, many people believe that banking performance is not coming, but ICICI Bank has continued to remain one of our top pick for quite some time, right from when it was 260, 270 rupees. And I think we continue to believe that it's one of the best banks from wealth creation perspective. And I think it continues to remain so. We bought Mahindra, we bought Tata Motors. So each of these stocks have contributed. When the entire world is focusing only on the renewable energy, we made very good money in BHEL, where we believe that thermal power capacity is going to get expanded, and it's only beginning. That we will have to expand capacity as a country, otherwise we'll run out of power. And based on this hypothesis, where the only one company which is qualifying for most of the BHEL and L&T, only two players, and BHEL has the largest capacity, and hence we bought it. So each of these talks have, I mean, I can go on hypothesis of each of them, but it'll take a lot of time. So I'm just picking one or two just to kind of highlight. Orchid, when we bought it, 350 bucks, it was probably one of the most disliked or most misunderstood stock. Today it has become almost 5x from where we bought, and including last 12 months, it's more than 165% up. So once you like a management and once you like the business, you just stay invested, and that's the secret source of wealth creation, and that we continue to pursue. Some new entries and exits. We bought Intra Building Material when it went public. Again, we found very high quality promoters. In a capex cycle, manufacturing is something what we've been bullish, and they build factories and warehouses for most large companies and market leader. And we had good ROE, ROC profile. Hence, we bought that, and it's done well for us. Paytm, like I said, we never bought any, in last 5 years, but we saw Paytm post recent regulatory challenges getting over. There's a significant moat in the business, and as that business is turning around towards more profitability, we ended up taking a bit on it. Ola, I did mention that we bought on listing and exited in a week's time when we felt that, a lot of return came in a short period of time. Does not make sense to remain invested. If we were lucky in that sense, finally stock came down. But I mean, it's a good story, and I don't still, and probably we might revisit. But I think, Biocon we bought recently, a very big play on biologics, CDMO space. It looks very interesting. KEC International we bought again on Capex cycle. We participated through the QIP process. Yeah, again, I want to say here that it was a very select, the close-ended QIP process run by the company. Not many institutions even got to see the deal, and we not only got to see the deal, but we got allocation also in that. So again, shows our strength in terms of tapping the source of deals and getting allocation towards us in that. Hyundai Motors, we bought on listing. We think it's again a good company, good both focused on domestic consumption as well as export with a good model lineup and long term, directionally right. So we bought in that. PHL, I already spoke about. SpiceJet, we took a bet on, turning around the sector with the capital being available. I think this is a good turnaround play possible, and the risk reward of investing is quite in favor, and hence we kind of bought. So some of these names are, there for you. So, and I'm sure, may be quite aware about also because you see in your statements, but generally I thought I'll give you quick download of what we've done. So this is about broadly about our what we have done, and I'll be happy to take any questions later when we get to Q&A on any of these things. Please feel free to, note them, write in the chat or ask in person. Now, I think one of the thing I want to now talk about is that in last 1 quarter, there's a very big noise happening that earnings are going down, and in fact, some people have made that it's been one of the most terrible earning in last 10 years, and I think a lot of, I mean, I get surprised. And one of the things which we have at Carnelian have always believed, and some of you might have read our letter, last month's letter, where we wrote beyond narratives that, how do you see things beyond narratives? There are narratives which gets created, but when you start, sort of looking at beyond those narratives, you find data and facts slightly different. So I thought, let me give you an insight into how do we see, what's happening at the earning level, right? And so, if you see Nifty earnings, of course, at a collective basis, you look at it might look very bleak and this thing. But if you delve deeper into it, what are the segments and sectors which have delivered, poor earning and what have done well? So if you see BFSI, earning growth has been reasonable. I would not say it's like, but that was not also even expected. Which was expectation, I think earning growth both for the PSU banks as well as the private sector like ICICI Bank has been phenomenally good, right? And which is again reflecting here. Export-based segments again for Q1 and Q2. Now technically you can say 18%. I mean, growth of 9% is bad growth. We think in every market cycle 9% growth is also not terrible growth. So and that is what kind of creates. And these are 1 or 2 quarterly blip up. I don't think they are like terrible growth from going away. That there's no more growth left in India, and one should kind of 1 or 2 quarters, little bit of slowdown can be there, but I don't think, the growth is still on an H1 basis. If I were to look at the 13% growth on export-based sectors, IT has done well. We have continued to remain bullish on IT despite all the, negative narratives going around. Pharma, again, if you look at the earning growth at 16%, right? Which is, in my opinion, in H1 perspective, is very decent. Uh, right? Of course, the commodity sectors, have contributed to the negative, part of the growth, which is fine. As a house, we don't take too many bets on negatives. We have not taken any, to be honest, on commodity segment because you need to be very, very smart and very on the top of the cycle to take that bet. Hence, we haven't really, invested into. So that part is pulling down the earning growth for the overall Nifty. But in general speaking, I would say you can see the how the growth is there if you break it down rather than just going by the broader narrative that earnings is kind of collapsing kind of thing or not happening. And we think that over next 2 years 14-15% kind of earning growth is reasonable, is expected to continue. 1 or 2 quarter blip here and there can happen, but we don't see much risk to 14-15% earning growth at an index level. There will be segments which will be growing fast, and it is a job of people like us to identify those right segment, right companies. And that is where it takes me to tell you what happened to our company's growth when we looked at in this period. So if you look at, our earnings growth, has been very, very robust, right? in Q1, each of the products has contributed to earning growth, right? So we have had whether you compare again, we comparing with X OMC and X commodities because ultimately we don't invest into those companies and they have different profile. But our earning growth has been reasonably good as compared to index, and we think that as long as we keep on doing that, analyze the company at an individual level within the sector and within the overall market space. And as long as we are confident that the metrics of this company we are invested into is in well placed and expected to perform better than the broader market, I think we are sorted. And this is what I was saying: faster, stronger, cheaper. So that part, I think, again gets reflected very well in the earnings growth. So we are not overly worried about so-called narrative of earnings growth slow down and companies are not growing in this market space. We are able to find companies where we have confidence that earnings are growing well, and which is again reflected here in the overall portfolio growth. And I would again request each of you to, let's read our letter Beyond Narratives, where we said that real money is made when you look beyond narrative. See, in our markets, time and again, narrative keeps on getting created. And, in the age today where things move very fast because of the social media, and all of us read the same WhatsApp message, and we are part of the different markets group and all those things. So today narrative gets created very fast. Five people start saying earnings are slowing down, everybody will start believing earnings, which might be true, but that may not be full truth. So I always, at least with the culture we have tried to create in our firm is that look at things what is beyond narrative, and that is a reason we have been able to things ahead of the curve, ahead of the time when nobody wanted to go talking about manufacturing. Why did we, or how were we able to pick up that manufacturing will do well in 2020? When we launched the fund, I remember so many people had argument with us that manufacturing will not do well, you will go wrong in this product. Today, it has got validated. When we picked up, power sector stocks in 22 and 23, most people were focusing on renewables. We focused on conventional power and transmission and all those things, right? Same way, when we picked up pharma, or IT for that matter, most people were not bullish on IT. So I think, and today the narrative has been also for quite some time that IT is not likely to do well. AI will disrupt IT. US slowdown will impact IT. The fact is that IT companies continue to grow. We have had situation where many of our IT companies in our portfolio has become 4 to 6x. Now, in otherwise narrative of IT slowing down, if you are able to identify companies, how? So, real thing is that money is made when you look at beyond narrative, focus on emotional focus on data, on events, analyze them, connect dots that what is making sense, and focus on risk reward. So our culture is always, focus on some of these things. And of course, when you take a call beyond narrative, which is beyond consensus, you need to have also because it's not that we are making hypothesis, we'll always be right. It never happens. We are not, nobody is perfect, and we can also go wrong on our calls. But the point is that when you go wrong, you have ability to digest the criticism and the ability to take calls beyond perception. And that is what we think that at least in our firm, we have created a culture where have stayed first focus on data, connect dots, if it making sense, don't shy away from making calls which are we have no sort of problem in taking, and that's the reason our portfolio looks very different. Many of you have told us that our portfolios look very different than the rest of the street. So maybe that's the reason that we don't shy away. We don't find comfort in being part of the crowd. We don't shy away from taking calls which are beyond consensus or beyond narratives. Now, coming to our current market view, how are we thinking? And again, we recently wrote also in one of the letters that we think it's a temporary headwind in, structural and, tailwind market. What has recently led to the correction of, we all know that, China monetary policy led to significant run up in the Chinese market, and which forced some of the emerging market fund manager to reallocate their weight towards China to become even equal weight, right? We all know that, right? And that's the reason, Indian investors, when the market saw some foreign outflow. And the funny part is that the narrative started getting created that foreigners are leaving country, there's something wrong with the country. That is not factually correct. Still India continues to remain high overweight market. But if you understand a portfolio manager's mindset, if he significantly underweight somewhere and something is performing well, he has to reallocate that weight somewhere else. Otherwise, he will run the risk of losing his job or underperforming, a broader market if it continues to do well. So what has happened is that I think whatever valuation disparity was there, Chinese markets are quite up. Partly it has got narrowed down. Note that Chinese market has, most people don't have strong conviction around Chinese economy and Chinese market. I am no expert, but I'm generally, whatever we talk to people, that by and large, this whole reallocation strategy is behind. Now, as the incremental flow comes, towards emerging market, India will continue to remain positive. And I think, that temporary headwind probably is over, but, it might continue for some more time, doesn't matter. We don't think, we but continue to believe India is one of the best market around the globe from an investment perspective, and that is not changing anytime in a hurry. Uh, Also, we have seen some slowdown in some sectors, which is, from a short-term perspective, whether it is commodities to some of the consumer discretionary plays or so, but which is again, we think that it's a cyclical downturn, nothing structural in nature, and hence, sort of we are not worried. And of course, as a little bit geopolitical risk heightened in between with the Israel aggression in Iran, and so that also created a bit of worry. So I think combination of two three factors led to this correction in the market. But I again must say that a lot of narrative got created that markets are falling. There's a big bear market starting, or it's only 10% correction from the top. It's not like some, and we have seen many such 10, 20, 30% correction in a structurally bull market. So we think that it's a very temporary kind of headwinds in a structural bull market. Our corporate profit to GDP in all the stories continues to, the structural driver remain in place. Whether it's our corporate profit to GDP continues to do well. Our leverage in the system is again one of the lowest, whether it is corporate debt to GDP or you look at debt to GDP, we are far away, far from leverage. And that cycle is yet to play out. And as that plays out, you will see more growth coming through. NPA cycle and we all know that our banking system is one of the squeaky clean, and so there are no asset quality issues. Of course, in this quarter we saw some segment of the asset quality and in microfinance coming about, and we saw banks who were exposed to that segment, took a beating, whether it is IndusInd Bank or any other bank. But we don't see, it's a very small portion of the overall thing, so it's not a structural or systemic risk. It's a segmental risk, which I'm sure with the provision and thankfully very because of the very proactive approach from the RBI, I think it is being controlled and curtailed so that it does not result in systemic issue. So I think a great part about our regulatory framework is that it's very proactive right now, and which is I think what I at least believe that it's a great thing. Our inflation continues to remain in a very tight range within the comfort zone of regulators and historical averages. So I think that's great. And our fiscal deficit is again one of the best managed and well placed across the again globally, I would say. So many drivers of growth is there. Manufacturing continues to remain as a growth driver. Infrastructure continues to remain as a growth driver. So all structural drivers of India has not changed. Liquidity, domestic liquidity, all of you know that it's very strong. I don't see any risk to it. That will continue. Foreign liquidity, one thing I can tell you, it is very much linked to Fed rate hike or Fed rate correction. So as the Fed was hiking the rate, in this period, we saw a lot of outflow happening, right? But as rate peaked out, started coming down, we saw some inflow. Except this China-related reallocation, I don't see any structural risks to flow towards emerging market. My conviction is that as Fed is cutting rate, our flows from developed market to emerging market will accelerate, and India will be a large beneficiary of that. I have no doubt in my mind. Now, whether it is 1 month later, 2 months later, that nobody can call out. My sense is that we have seen broadly FI flows bottoming out, outflows bottoming out, and we will see positive flows coming through. Again, valuation, I have said multiple times, I don't think markets are greatly expensive. Markets are not cheap. They are in a reasonably good range. Of course, they are not closer to the mean. as many people call out that Indian markets are expensive than mean. Of course, they are expensive than mean. But please understand, in a transformating economy, India is transforming. In a transforming economy, reversion to mean doesn't happen. Mean actually ends up going up. But reversion to mean necessarily does not happen unless there is a structural crisis or some big Six Sigma event happens. That nobody can, Six Sigma event nobody can play out. Structural risk, I don't see much. So hence my view is that reversion to mean probably may not happen. Mean will be upward sloping curve, and that would be a journey as far as the valuations are sort of concerned. Some of our sectoral view, from next, at least 12 months perspective, we're quite positive on private banks, select NBFC, life insurance companies, we're quite positive. IT, ER&D, and cybersecurity space, we're quite positive. Manufacturing, we think that the great opportunities. Pharma, CDMO, chemicals, we've been very, very overweight and we continues to remain. Auto component companies, there are specific focus companies we like, and we have taken quite a bit of exposure on that. Power companies and ancillaries, we continue to remain positive. Consumption stocks, we are quite positive. Again, I'm not saying by and large broad base, but on a select basis, you are able to identify companies which will do very well, and we have been able to do that. Like I was talking about LT Food, we think it's a great company and doing very well. And we have seen that even it doubled in 6 months' time, and otherwise slow consumption mindset. So we are quite okay on that. Uh, Sectors where to be watchful, we are right now in terms of capital goods company, while structural is doing well, but we see excess valuation happening there. So one has to be a little bit careful in terms of when you invest into companies there, similar to in some of the EPC infra companies where some of the valuation stretches happened. Our defense railways, I've been saying for 3, 4 quarters that I see stretches happen on the valuation. Companies will do well, sectors will do well, probably for some time. So you might see some sort of consolidation happening or correction happening. So we are right now quite careful in some of these sectors before we buy. Our bar on these in terms of I think is very, very high. Uh, this, I think, as spoken, deep correction in India happens only in historically 30, 40 years, only because of five reasons. And if you see each of them are very well placed. Current account deficit, from has come down from 4.5% to 1%. Banking system, like I said, one of the best. Debt to GDP, fiscal deficit, and inflation. All of them are well placed from a structural perspective. So I don't see a deep correction happening in India, in next, anytime soon. Critical corrections will keep happening. And what I want to relate the current market situation to this chart. This chart explains it very well. 20 March 22, March 20 COVID happened, and as started recovering, 20 did very well. 21 also did very well. But if you see, most people started invest because there was a lot of skepticism throughout 20 and pretty much first half of 21. And then people started investing money. But by then, a lot of ground had been covered, and we saw a good correction in the market in late 21 or early 22, and largely around the Ukraine war. And if you remember, so second half of 22 was quite painful for people, and skepticism again went up. People stopped investing. But that bad period or that consolidation period, I remember, we wrote our investor letter. There's no title which is there on our website. Embrace volatility and build this vintage. We said this vintage will be a very good vintage to hold in your portfolio. This was, we had written in July, August 22, that this vintage of the portfolio is going to be great portfolio vintage to build. And you saw what happened in 23 and 24, right? We had a great run, people made money. But I can tell you, most people became negative in that period of post Ukraine war, second half of 22. Most people were not even willing to look at markets, and so I see today this correction phase, which might last 3 to 4 months, 5 months, I don't know how long, could be 6 months, is that painful period that of second half of 24 and maybe first half of 25 may not be great period from a return perspective, but it will be a great period from a vintage perspective, because in equity markets you always see returns in a step function. It is never linear, it is never one way, because market tends to overextend on either side. So you might see some more pain continuing for next 3 to 6 months. And when I'm saying pain, it could be just sideways consolidation, not much return, but could be this vintage is something what one could look for. And honestly, I don't call it bear market. 10% correction from the peak is par for the course, much needed correction, healthy correction, and which we all should not be worried about it. So yeah, India looks good from medium to long term. Short term trim down one's expectation. I'll repeat, we don't find markets very expensive, but neither cheap. Pockets of exuberance are there. Your job is to avoid in that. We always avoid poor quality management. We will only one thing which we don't do. We are very clear. When people ask me what will you not do, we said we will not bet on crooks. When we believe that quality of the management is not good, we will not invest into that. That is our, clear no-no. And that we continue to believe. Um, Right now, deal flow activity is very high. Every company, good, bad, wants to raise capital. It is very hard to differentiate, very often when you have so much of flow. But that's our job again, to keep our emotions in check, stick to discipline. That's a very, very, and I would talk that to recommend everybody who invests in the markets that stick to a discipline. These are the markets where you get carried away when so many deals are coming. Raise your bar for quality, raise your bar for, selection of the stocks. It's very, very, lots of activity, and within that activity, staying focused is always very challenging. We don't see any systemic risk into the market, though risk always comes. My fundamental belief is risk always comes from unknown and unexpected sources. Only way to prepare for the risk is quality of the portfolio, no other way. One cannot predict what will happen. Anybody who predicts, according to me, is at best it's a fluke. Nobody can say this will come from this shore at this time from these sources. You can be right by fluke, but you can't be right consistently forever. At least we are not able to do that. So our focus continues to remain that build good quality portfolio as we have done, where we have conviction they can deliver faster, stronger, cheaper growth. And we are committed to creating long-term risk-adjusted return for our investors and client. Uh, Thank you very much. I'll pause here and let you ask questions. So feel free to raise and ask question. But I will meanwhile, if you have a question you want to ask directly, please raise your hand. Meanwhile, I'll take some questions from the chat box. We have lots of questions, so I'll try to summarize and take some of them or all of them as possible. Um, Why did we buy Hyundai for such a high P, being value buy and parent is trading 5 P cheaper? So look again, if you see that way, every parent which owns, it's like look at Unilever versus Hindustan Unilever, Colgate versus Colgate India, or you look at any MNC, because those markets are not so growth markets, and as a result of that, we all know that growth commands higher PE and higher valuation, and so our conviction is that we are investing into Indian markets, and I would rather play India growth story than playing Hyundai at a parent level. I have no understanding of those markets, so hence, I know that we did a lot of study, and I think Hyundai is structurally very well placed in India. Uh, and by the way, its valuations are cheaper than Maruti in that sense. So it's not like crazy expensive. It's 18, 19 times P. So for a growth, it in my opinion deserves that kind of valuation. When you can pay for Maruti, why can't you pay for Hyundai? So ultimately, you have to evaluate based on your comparable peers here and what is the business model superiority of that, or what can you pay on that. So that is what our thought process. Your views on the AB Capital in one of our portfolio company. We like it. I think the management is doing a great job. Again, this is one of those company. At time we get worried, we get perplexed that when the results are so good, why stocks are correcting? I mean, this last every quarter for last 6 quarter, a company has delivered fabulous return, what any investor would want. And but stocks can correct for many reasons, many ways. You can't control them. Right now, I think there's a heightened worry about NBFC space. We have done our work. We have kind of again rechecked post recent correction. Also, we are not worried about either quality of the management or quality of the portfolio, quality of the business. In fact, it's got only cheaper and better. So we have bought even added in all our funds in the recent times. My view on Adani case, I think, I'm no legal expert, but I think, this, we have seen what happened in Heidelberg. I see, again, there's no right and wrong on this. There are a lot of conspiracy theory going around. I am always surprised with the timing of the whole thing, with the administration changing, why it is happening. So I think there is, in my opinion, a little bit conspiracy there, a little bit. I mean, I don't find my limited view. I may be wrong. Not that we own any stock in Adani, but uh, there seems to be a little bit more, conspiracy behind around the whole thing than a lot of facts. But let's see. I don't have too much detail on the facts of the case. Uh, You had mentioned Nifty bottom around 22,000 to 25. So yeah, I mean, see again, putting a number is always a challenge. My broader sense is that Nifty should not go below 22, 22 and a half, and on the higher side probably. So it will trade, for a consolidation range of 22 to 25 kind of range broadly, depending on what kind of news flow. So it's going to consolidate here for some time is my sense. Hence, we've been kind of taking in our time to deploy capital whenever we get new money. So, yeah. So, but again, look, markets can always surprise you either side. While Nifty is a number, but we again go back to look at companies and uh, Bale cannot make profit for next 10 years, but that's a view you have. We don't have that view. Uh, so Bale is the only in India power capacity has to build. There are only two players, BHL and L&T. There are situations where BHL is the only player which quotes for that. The EBITDA margin expansion is happening. They are also have lots of play in defense and railways. So we think it's a capex cycle is picking up. Companies really working hard in terms of getting next year profitability will be far different than this year. Uh, so I think of course every capital good stock is quite expensive, so you can't really say that it's cheap, but you will see profitability coming through very soon. That I can assure you. I have no doubt on that. Uh, our view on real estate, we are quite positive on the real estate sector because structurally speaking, whenever an economy grows, demand for housing grows, demand for commercial space grows, and we are seeing that happening. And fortunately, post RERA, a lot of a lot of sanity has come into the sector, a lot of customer protection has happened, and hence I think the sector is likely to do well, and currently it is significantly underrepresented in our market cap. So you will see only that changing in times to come. What different did we find in JM Chemical? JG Chemical again, niche industry, fine entrepreneurs, great entrepreneurs. Two young brothers, energized to and determined to build $1 billion company. Hardworking people created their own niche with a high entry barrier, or let me put not high entry barrier, but a very reasonably good entry barrier. So we felt that and coming at a reasonably good risk reward, and stock has really paid us well. So whenever we find great guys and great people in a decent business and decent, high entry barrier, decent entry barrier business, we don't mind taking, good bet on that, and that is what we did here. Um, if somebody wants to put money and top up on your shift strategy, what do you prefer? Suggest STP or lump sum? Look, again, that's your call. I would, I have no scientific way of saying that. If you're not comfortable putting lump sum, you can do STP. My sense is that markets are, in the next 3 to 4 months, 6 months, will be a sideways range. So you can decide whatever ways. If it is long-term money, in my opinion, lump sum can be there. But, it's really up to your comfort. I mean, either way is okay. What is our view on PSUs? PSUs, I have no view. I have view on sector and PSUs in those sectors. So we like right now PSU banks where we think good risk reward is there. A lot of correction has happened. Many PSU bank stocks are below one time book with 15% ROE, good asset quality. We think that over next 12 months they can do well, and hence we are not really much worried about. I mean, we think that they are in fact positive from here. So PSU you have to look at. We don't like oil marketing companies, but do well. So defense PSU we find a little bit overpriced. So again, you have to evaluate each company, each sector, and each company in the PSU. Defense and railways I have already covered. Done, yeah, covered. We are holding Aarti Industries even though it is bleeding daily. Yes, Aarti Industries, I think, had, though it is above our price, but it had a good decent correction from the time in last, I think they had a big quarter, but our view is that we have had huge interaction with the management. Most, and with the new CEO coming in, he has taken a lot of cleanup write downs, and hence it looks like a big sort of drop in the profits. Our view is that this bottom is behind. What's this behind? Stock has bottomed from here, and over next 2-3 years, the new CEO is putting the company into good growth trajectory. And structurally, we are bullish on chemical sector, and Aarti is definitely one of the good quality company in the chemical sector. So with the new CEO, I think it is all the more looking attractive from this space. So we are quite okay holding this space through this drawdown phase. Uh, AB Capital, I have already spoken. Impact of freebies by state on central government balance sheet. Impact of freebie on state governments does not have much impact on the central bank balance sheet, but yeah, too much of freebie culture is not good. But at the same time, I do see freebies in a very different light. Some amount of freebie is basically good for the lower end of the society. Think about it. Western countries are still debating about universal basic income, that everybody must have some basic income. Our freebies, or so-called, these many of these schemes are nothing but a different form of UBI implemented in India. And hence I am quite, to some extent, on a reasonable way, it is quite okay. If it goes out of the hand, we should worry. But we must say, as India grows, the lower end of the society must have access to the basics, and I really like when government has done Ayushman Bharat, where poorest of the poor has access to the basic healthcare facility, which is a good thing. So I'm watching, but I don't think it's alarming at this stage. Comment on Spark, Sun Pharma Research. I think Spark is one of those companies which is in my opinion doing path breaking work. Of course, this nature of the business of Spark is also, if you see, they are in innovation, right? And NCE is something companies with hundreds of billion-dollar kind of pocket do. India has 4 or 5 such companies which are doing NCEs, and if you succeed, even in one molecule, you can become 100x, that kind of. So this is a very high risk reward payoff. The way we understand it, that if one of them succeeds, the stock would probably be on circuit for next 30 days. So this is the kind of bet it is. Only, I mean, so we have a very small portion in our folio, where we are prepared for extraordinary risk also, so that even if tomorrow it becomes half it, we don't worry. But this is one of the bet. We think some good developments are happening in some of the drugs, and if they turn out to be true, it could be a very big multi-bagger. So hence we took some small bet which gives a significant alpha in case favorable outcome comes, and according to us, there's a good probability of that happening. Hence we bought it. EV penetration, I think EV penetration is going well. We right now are, I think two-wheeler segment, there's too many competition. No, of course, we will see who the winners are in time to come, but I think four-wheeler EV penetration is continuing to do well. Mahindra really, doing the Tata Motors doing well. We own both the stocks, so I think we're participating through them. Lotus is not performing well for last 1 year. Again, let me build a perspective. CDMO is one of the very large opportunity in over next 5-10 years. It is very much similar to what IT was in mid 90s. Uh, if you see, with the passing of Biosecure Act in US, you will see a lot of business moving from China to India. And Loris is one company where which is capacity is ready and business has to come. So if you want to see Newland is also in the same business, right? Newland stock did not do well for a good 1.5 year period. But one contract or two contracts suddenly made the stock 8x, 10x. So I feel Loris is a very capable company, very competent company. Business is yet to come, capacity is ready. So, one or two quarter of good business will change the future of the company. So we are okay. If each of our stock does not perform for 1 year, 6 months, we are perfectly okay. As long as we know that it's on the right path and in 3 to 5 years it will perform. I have no doubt in my mind that Loras in 3 to 5 years will do very well. It may not do well in 3 months, 6 months, and we are totally okay with that. FI flows, I think, but I think covered about FI flows. Uh, What's the realistic return expectations shift PMS over next 1 to 3 5 years? So don't look at our historical returns and say that we will do same returns. I would say in equity market, keep the expectation low, 15-16% return, keep anything above is bonus because the beauty is that if you invest with lower expectation, you are not disturbed much. And that's how we want to tell all our clients that invest with lower expectations. Returns will be given by the markets and the kind of companies you invest into it. Our quality filter, you've seen us over 5 years, you've seen us how we picked up the stocks, how we picked up the trends. We'll continue to do well, but keep expectation low. When we launched our shift strategy, I remember one of the investors asking in October 2020 that what do you think will deliver the returns? I said that time 18-20% return. It ended up giving 47% return. I had zero idea what return we will give. I said invest 18 to 20%. जो ज़्यादा आएगा आपका ही है. So same way I would say, of course, markets have done very well. So we are sitting on a very good performing market. So keep the expectation 14-15%. Whatever comes is only yours. We do only in your account. We don't take away that. So uh, Huzefa, you can ask verbally. You can raise your hand and ask question. Anybody who wishes to ask. So uh, please go ahead. Chemical sector bottomed out. Yes, we think that that's the reason we've been overweight. It might take time, but you can be wrong by a few quarters, but you may not be wrong by a few years. So we like to take exposure when nobody's looking at it. Like I said, beyond narratives. Today, narratives is bad for chemical sector, but we have found our own stories and we have invested into them. You have delivered great returns and must say it's above expectation, but challenge now is investor expectation have moved up. Absolutely. And that's an I'm saying biggest risk in the market today is the high expectation. People think that 20% return is not exciting enough. And, as a result of that, you end up taking more risk, which is not great. I tell everybody that, great risk or higher risk does not mean high returns. It's a wrong narrative that high risk, means high return, low risk, means low return. I would like to tell you when you invest into manufacturing in October 2020, was it a high risk or low risk? It was low risk but high return. When you invest into ICICI Bank at 260, 300, 350 rupees, was it a high risk or low risk? So actually you took low risk and made high return. When we bought Aditya Birla Capital at 100 rupees, it was actually low risk and high return potential. So investing actually the right thing which you need to is no high risk, high return. It is the perspective you invest in. How do you evaluate your risk reward? So as long as your risk reward is offering superior return, I mean, is favorable, that is how you invest. So my suggestion to everyone is that, please don't raise expectation. Making 20% return consistently for a long period of time is not reality. Uh, and that will be, in my opinion, if one is raising expectation, you will end up seeing wrong outcomes or you end up taking wrong risks, I would say. Our view on data centers, I think we like data centers. There's no doubt on that. It's a structurally great opportunity. Of course, very few limited plays we keep looking for. Currently, we are not invested into any, but it's a structurally great opportunity. On IT company, many AMCs are not recommending, but that is true. But we continue to believe it's a great sector, great stories, great free cash flow, good returns. So we have been able to find our companies, and others might not be recommending. But like said, we have to invest based on our conviction and beyond narratives. Is it a good time to top up, or like I said that top up is your call, but like 3 to 6 months, I feel there will be great vintage to invest, just like how it was in second half of 22, and hence, but you can decide based on how you think is right. Can you inform us about unlisted space in Farm? You sold us a huge value and stock plummeted about 90%. I didn't sell any pharmacy to anyone. I don't know who sold to you, but we never bought pharmacy. I had no idea who you may be talking about, some other AMC. Uh, Mr. Siddiqui, neither, we never invested into pharmacy and we never liked the business model. And again, it may be a great company, but we didn't buy and we didn't invest. So, uh, but he's writing we are very defensive in just Jasmine is writing that we are very defensive in shift strategy. We play defensive, we we will do as based on our risk reward framework, and I think it's worked very well for us, and we will continue to do that. Why don't you own any AMC or wealth management portfolio in your portfolio? We do own, I think, Aditya Birla AMC we own, and many of the other AMCs we own through ICICI Bank and so through indirect holding, but we own AMCs. Aditya Birla AMC we own directly, and we like. What is your churn in Bharat Amritkal Fund so far? It's very minimal. I think probably it will be point 0.2 or point 0.3 something. I don't remember, but it's just very recent. So we haven't sold much to be honest, except I think when Ola Electric, which I was talking about. But we haven't sold much stock, so I would not even think it will be point 0.3. It'll be probably much lesser than that. Go aggressive, too many large caps. Again, look, I think this is again a myth that only mid cap is, great returns. Large caps are not great return. I am again telling you, Deepika, focus on risk reward. We made 5x return in ICICI Bank. We made 4x in Tata Motors. We made 4x in Mahindra and Mahindra. We made 5x in Cipla. So I think I can tell you name after name. It is not necessarily mid or large cap which determines the returns. It is the framework of investing, looking at the risk reward, that determines the outcome. So we will continue to follow the process which we have followed over the years in terms of, the risk reward framework, identifying right companies, right management, and taking call, ahead of everybody else, ahead of, time. That is what according to us determines. The aggression is when you like a stock, go aggressive. Whether it is manufacturing, whether it is Yatharth, whether it is ICICI Bank, whether it is Aditya Birla Capital, whether it is Ola, whether it is Paytm. If you see, I've been very big critical of many of the new tech companies, but when we understood Paytm, we bought. So we have no permanent thing. If we understand the risk reward, we'll buy. So we will continue to follow up our philosophy. But thank you for your suggestion. Would you recommend to invest in a FOF, investing in Carnelian Bharat Air along with other AIFs? Look, again, that's the call you have to take evaluating that product. I don't know, how you want to evaluate. I think if you have minimum, 1 crore to get exposure to 4 AIFs, that's a better product. But, otherwise you can directly invest. That's a call you have to take. I'm probably not right person to advise on that. Um, It's being said that Trump tariff will not affect India beyond 10%. What's your view? Again, taking any call on Trump is given when they are going through their policy is very difficult, but it's very likely that Trump will push for manufacturing locally, but everything can't be manufactured locally in China and in US. So some India will, in my opinion, US Trump administration at best will be neutral to positive. I don't think any negativity of the Trump administration towards India. It might be negative for China and Mexico and some of the other countries. So I think I am not really overly worried about what's happening in fact, I think it's slightly positive. Inflation is very sticky, Arjun, and hence narrative of RBI reducing rates might be more prolonged than expected. So that's fine because see, anyway, cost of capital is lower in India than many global markets. So I am okay. RBI reduces the takes its time to reduce the cost of capital. I think it, let the inflation come under control. There are many levers at play. As long as we are even maintaining the current cost of capital, we should be fine. And so I'm not really overly worried about uh, think Mr. Siddiqui, you were writing again and again about farm easy. I think you probably come on a wrong call. I have not offered any stocks to any investor. So please, I think request you to keep your comments to yourself. I don't think we have ever bought farm easy and we have sold to anybody else. I think probably you got wrong information. That's the guy who sold you. Uh, F5 flow like Concord Biotech has quite corrected quite a bit. It's a phenomenal company. We love it from a long-term perspective and by great team, great business model. We think we don't see much correction in that from here. So I agree with you that I think it's kind of bottomed out. Any idea when unlisted CSK will be IPO'd? I have no idea, sir. Yeah, I find it very hard when it will, but I have no idea. Capital market related stocks, they are good companies. Capital market is a structural thing, so all the AMC wealth management platforms will do well. But again, I will say that evaluate based on the risk reward. Some of the stocks have become very expensive, so hence be very careful before evaluating individual stocks. But structurally, they are positive. I don't have a view on Maharashtra Seamless and Sangvi Movers. Uh, Container Corporation we like because I think again they have a very large. Basically that once the dedicated freight corridor, Western dedicated freight corridor goes live, they are expected to get a significant jump up in their revenues and profits and I think from here it looks good. Stock has corrected from the time we bought, but we are happy to stay with the correction and sort of take the correction in the chin and we stay invested. We think structurally it's a good business. So will Eclux has run up so much. Yes, it has, but I think it is still one of the cheapest stock. So I think there's the new CEO is doing good job. We are evaluating if we think that we need to sell, we will sell. But currently we are kind of invested. NSC in unlisted market, we think NSC has kind of played out quite a bit. We are not buying anything right now. But yeah, it's a good company, but may not be great investment. So I think I've covered most of the questions from the chat. If there are any questions, I think somebody has raised hand. I mean, Avnish Khara, you raised hand. Can you please go ahead and ask the question?
Hi, Vikas. Can you hear me?
Yes, Avnish.
First of all, thanks for this. Always nice to get some perspective from a seasoned investor. I have three questions. I just wanted to get your opinion on the MFI cycle and whether you think that the third quarter is, where we see the highest credit cost pain, and then there's a recovery in the offing maybe, and it's time to start looking at MFI stocks. Secondly, just wanted to get your view on it. Seems that RBI is trying to clamp down on all companies related to credit because they seem to have be of the opinion that a chunk of this is flowing back into capital markets and leading to excessive liquidity. So just your view on that. And thirdly, since 2nd of November, AMFI has introduced certain regulations for mutual funds. So do you think that that has also had an impact in terms of market correction, or is it just a function of earnings?
Microfinance, I think in last and thanks to RBI, again, like I was saying, that regulators done a great job in terms of playing counter-cyclical. We saw some NBFC and some companies grew microfinance 35, 40%, giving the third loan and fourth loan to same borrower, which is not healthy. So I think we saw some pain coming in Q1 and Q2. I think probably one more quarter of pain is left. And there also, I think companies which are sensible and disciplined will come out well. But companies which kind of have taken excessive risk will have a big knock, and we saw some of them kind of paying price for that. My sense is that Q3 will be the worst quarter, maybe worst will be behind with that, because there's a lot of agility in the system. RBI is kind of pushing. So I think that should be okay. Same thing, I think RBI is also putting on unsecured loans because that's going towards some amount of money in unsecured loan is going towards IPO and markets, which is worrying sign because banking money going towards people borrowing and paying 18% interest and going towards market may not be great. And RBI has taken cognizance of that, and I think they are pushing on that. So as long as regulatory awareness is there, participants will get disciplined, and it is not systemic risk, but it's a worrisome point. And I think some part of correction will happen, whether it is through, some changes. I like regulators which are counter-cyclical, which whenever excesses happen in the system, rather than waiting for it to blow up, they come, proactively and kind of give knuckle to the players and say, guys, get disciplined. I like those kind of regulators. So I think even whether it is MP or whether it is SEBI or RBI, whoever does it, I'm kind of always fine for that. Chandresh?
Hello,
Yes, Chandresh.
I'm audible, sir.
Yes.
Sir, just want to, can you just reiterate that your valuation slide on your this presentation, little bit more elaborative on because apart from mean, how we can understand that particular slide?
The piece valuation one.
Yeah, valuation part.
See, again, if you broadly look at what I wanted to show in that, it's not that like, see, right now,
Yeah,
if you
this one.
see, you are one standard deviation away from the mean, right?
Okay.
Now, this is your historical average, and, so this is where you are right now. So
Mm-hmm.
you are around 21, 22 times whatever earning, and historical average is about times, right? So if you see in a transforming economic point, I was trying to make is that, your mean keeps on going up because eventually, you are structurally getting re-rated as a country. And rather than P coming to the mean. In a stagnant economy, you see this kind of cycles from a valuation perspective, but the economy transforms, like one example I like to give is Japan had similar kind of cycle from 65 to 89. In that period, Japanese market did very well. And at the peak of the Japan's transforming journey in 89, Nikkei was trading at 60p. So, and in throughout that period, P kept on getting expanded. It never reverted to the mean. And mean kept on going up. So that is the point I'm making. Dr. Sawal?
Ah, sorry, not. Uh, yes, I just wanted to know about the behavior of Reliance and Tata Motors, particularly, since last few days or few weeks, they are behaving. It was expected that Reliance will also cope up, but they are just maintaining a low level. How is that? Any opinion or any guess on the behavior of the Reliance Industries? Because their last annual AGM, they were very motivating and very encouraging speech, and the total performance was there. But we are not finding in the behavior of the stock.
Reliance has its own journey. I think it is consolidating for last couple of quarters. But I think business-wise, I think there was a little bit of impact because of cycle with the ONC business. In general, I think we like the business to be honest. Especially there are a lot of triggers like demerger or listing of Geo and other businesses. So structurally, we are not from here, and we don't see much downside.
Okay, thank you.
Huzafa? Huzafa, you want to go and
Hello, yeah, thank you. Suppose there's an investor with 2 CR and he has a 3 to 4 year horizon. Which of your product will you recommend personally and why?
I think it's again depending on what overall exposure to any investor is there. If you're looking for a a small and mid cap kind of portfolio, I think shift strategy would be good. But otherwise, in general, our Bharat Amrit Kal Fund or compounder strategy would be fine because that's a multi-cap design across all themes of the portfolios. I would say for a general investor, Amrit Kal or a compounder, any of them could be good, or for a small mid cap, shift strategy could be good. Uh, Apurva?
Yeah, hello. Yeah, thank you,
Yeah.
sir. Yeah, I just want to know the view on Indostar Capital and this Capacite Infra.
We like both companies. Indostar Capital again is a company which has been transforming. We've been owning since 100 rupees. We own almost close to 5% of the company. So we like the company. Uh, they are growing the business. They've just come out of the bad period and now they're focusing on growth. So we think it's structurally a good story. And Capacity Infra also is a good story. As India is building a lot of infrastructure, they are sitting in the middle of, especially the high-end towers. They are very, very, capable. There are very few companies which makes tall, 50, 60, 70 story buildings. And this is one of them. So I think this company will do well on that.
Okay.
Dhaval? Jasmine?
Hello.
Yeah, Dhaval.
Yeah,
Yes,
thank you, sir.
मैं hello.
Yes, go ahead. Jasmine, go ahead, please.
Yeah, सर मैं 5 जून को ही मैंने इन्वेस्ट किया है लकीली मिल गया है तो हो गया सर
Your voice is breaking.
हेलो
Your voice is breaking.
हेलो
Yeah.
मैंने 2 3 महीने पहले ही किया है जून महीने में मेरा investment था आपका इनोवा कैप्टिव और सर पीसीबीएल का रिलेशन बहुत अच्छे थे सर मैं पूछना चाहता था कि इतने इन्वेस्टर बढ़ रहे हैं इंडिया में तो सीडीएसएल और प्रोटियन के बारे में आपका क्या ख्याल है और डेटा सेंटर थीम को आप ट्रैक कर रहे हो सर
Yes, we are doing data center theme. We are tracking. We haven't invested into any. I think CDSL, Protean, all are structurally positive companies. But one has to again look at price, risk, reward. Currently, we have not owned any of them.
ओके सर एंड सीडीएमओ बिजनेस में सर कोपरान अभी कंसिडर कर सकते हैं कोपरान
CDMO में we own Loras, we own Syngene, we own Newland, we own quite a few companies.
ओके ओके सर थैंक यू सर
Dhaval?
Hello, sir. Thank you, sir. Sir, I want to know your views on air conditioning and refrigeration sector. These have low margins, but all these products are very well underpenetrated in India.
Positive. Again, it's a sector segmental wise, directionally positive. You have to evaluate each company. Directionally, more air conditioner will be sold. Every factory, every mall, every infrastructure, metro, everywhere, we have more and more air conditioning. Directionally, it is positive. But again, individual company, you have to evaluate.
Okay, thank you, sir.
Nikesh?
So you said you mentioned in your PPT that you are bullish on insurance companies. What's your view on Star Health Insurance, considering that top line is increasing, consistently, although it's not translating into the EBITDA, but with the IDAI report that they might have a common license for all insurances. What's your view on that?
It's again for valuation reasons we have not bought. So our team is evaluating, but I don't think, I don't have a latest view, but my team is evaluating. So last we didn't buy because of valuation, and stock has not done well, I guess. So, but we'll keep evaluating when we find risk reward is there, we'll buy. But it's a good company, but probably, like for right reason, profitability probably is not this thing. I think we will have to probably take one or two more questions. Who should I take? Tul?
Hello, sir. How are Hello, can you hear me?
Yeah.
Okay. Just wanted to quickly check. I mean, I will not take much of time, but in Tata Motors, something which is kind of showing some erratic kind of movement for the last like couple of years. Just wanted to check where do you foresee Tata Motors on the downside? So that's a fundamentally good, solid company, but then the stock is kind of in continuously correcting. So that's something which is kind of not able to fathom the reason of
किसी
it.
कंपनी का थोड़ा बहुत क्वार्टरली करेक्शन आता है, कोई बात नहीं है. थोड़ा you can't make a lot of money every time, so every business goes through a bit of a correction. I think it's because of the international business, a little bit of correction has happened, but
हाँ,
otherwise they are very good solid company and transforming in a good journey. So
right.
I think probably next couple of quarters still might be tough, but eventually it will do well.
No, the reason of the question was basically, since we have picked up Hyundai, I mean, Tata Motors at this rate, I mean, wouldn't you find it attractive enough? That's the whole reason of the question.
We already own Tata Motors in one of our fund.
Okay. All right. Okay. Thank you so much, sir.
Okay, I think probably we'll pause here because I think we'll have to end the call. But I know if we've not taken some of the questions, please pardon me, and we will probably take later, and you can write to us. But thank you very much for your enthusiastic participation. I always look forward to have this interaction. Thank you very much.
Thank you everyone for taking out the time and joining this call. Have a good
Thank
day.
you. Thank you.